Hello my dear learners, welcome back. We are learning the DYBMS Semester 5, the Commodity and Derivative Markets. In the previous lecture, we had learned the introductions of the commodity market and the derivative market. Now today, we're going to learn the Unit 2, the Chapter 3, Future. In this chapter, we covered the meaning of the future, characteristics of the future, the sub-terminology related to the future market, and the concept of the conversion, where we talk about the arbitrator, contango, and the backwardation. And finally, we will going to learn the pricing, future pricing model, that is the cost of carry model and the expectancy model. So let's start. So let's start the definition and the meaning of the future. A future in the financial market is a legal agreement between the parties, that is the buyer and the seller, for the underlying assets or a security for the predetermined price in the specified time in the future. So, the future market, if any person entered in the future contract, so they both parties have predetermined the price and the time for the future contract. So, again I revise, a future contract is a contract of the buyer and the seller in which the formal to be buy a specific number of the share at a predetermined price at a specific time for the future. So every contract is regulated by the stock exchange or the clearing house, which is and the agency that looks after the asset that traded on the stock exchange. There are the differences between the option and the future contract, but the future contract is more easily traded. For the above, you must have understood about the future theoretically. Now let us understand by the practically, and I'll give you one example. For example, if someone want to buy a September crude oil future contract, so they make a future contract that they will be buy 200 barrels oil from the agreed price as of the September's expiration, whatever the market price at the time in the September. The seller is also agreed to be the sell those 200 barrel of the oils at the time or agreed period of price. Now in this case, the both seller and the buyer are obliged to the buy or the sell the 200 barrel of oils unless they are trade with the others buyers or the seller. So the traders can also be buy the future of stock, index, funds, foreign currency, exchanges, etc. So this is the simple example where the one buyer need to be the 200 barrels of oils and the seller is agreed to sell this buyer to 200 barrel of oils in the month of the September. So these are the come together in the agreement and the buying and selling of the product or underlying assets. So let's segment is the characteristics of the future market. The first characteristic is there are two parties. Of course, there is the agreement between the buyer and the seller. So there must be two parties. Now the second one is organized exchange. So futures are the trader in the organized exchange with the designated the physical location where the trading taking place easily. So this provide the ready and the liquidity market in which the future can be the bought and the sold at any time. So the stock market exchange is the trading the future contracted. The second point is the standardized. The standard of the future contract, the both are the predetermined of price and date. So standard of the both price and debt makes the future contract. Now the fourth point is the clearing house. The exchanges act as the clearing houses to all the contract stock on the under the floor. For instance, a contract is struck between the A and the B. Upon the entering into the record of the exchange, this is immediately replaced by the two contract, one between the A and the clearing houses and another is between the B and the clearing houses. So clearing housing play the mediated role between the A and B. Next important features of the future market is the margin. The exchange require that the margin must be the deposit with the clearing house by the member who enter into the future contract. The amount of the margin is generally 2.5 to the 10% of the value of the contracted. That can be for. Now the next important features of the future is the margin. The exchange required that the margin must be deposited with the clearing house, a member who is entered into the future contract. The amount of the margin is between the 2.5% to the 10% of the value of contract, but can be varies by the contractor or the clearing houses. A member acting on the behalf of the client, in turn it require to the margin from the client. So the margin can be the form of the cash or security like the treasury bills or bank letter of the credit. So the margin is the amount is paid to the clearing house. Now the next is point number 6, that is to be the marking to the market. The exchange uses the system called the marking to the market. At the end of the each trading sessions, all the outstanding contract are to be repriced at the settlement price of the that trading section. It means that the end of the trading sessions, all the outstanding contract will be the calculated, and this would be the mean that the some participation would be make the losses and the some participation will make the gain. Let's discuss the future terminology or future market terminology. The first terminology is the spot price. As the name of the spot means the current price at the marketplace of the given particular assets. For example, the spot price of the gold is today 49,350. Now the second is the future price. The price of the given particular assets of the future date, it's called the future price. Maybe the gold price in the future or after the in the month of the September is the 50 to 52,000. So this is the prediction price. Now the third one is the expiry date or now the third one is the contract cycle. The contract cycle is the period where the future contract to be exchanged. Mainly the future contract or the contract cycle is for the 3 months. Next is the expiration settlement date. The expiry date when the contract after expiry date is no longer or it is not valid. Now the next one is, and the next future terminology is the lot size. A lot size, it's the deliverable quantity to the stock, to debentures or other financial instrument underlies to the future or the option contract. For example, the Reliance lot size is to be 500 or any other stock having the different load sides. So load side can be the vary depending upon the stock. And next one is the contract value. A contract value is the important metric that measure the much a contract is worth and after the execution, including the revenue and the fees. So the contract value, it's the including all the revenue of that particular stock and the fees. It's called the contract value. The next terminology in the future, that is the basis. The basis is the subtracting of the future price over the cash prices. The basis can be the positive and negative. A basis can be the positive or it is called the over when the cash price is higher than the future price. Basis can be the negative if it is the cash price is lower than the future price. It is also called the under basis. Next terminology is the cost of the carry. The cost of the carry means the cost associated with the carrying value of the investment or any financial instrument. It's called the carrying cost. For example, the brokerage fees, the insurance or any other charges is including the cost of carry on the investment. Now, the next terminology is the open interest. The open interest means the total number of the outstanding deviation contract, such as the future and the option is not settled. It is called the open interest. And open interest is a total. It's a total of the contract of bought and sold, not for the each side of the contract. For example, if in the market a buyer having the 10 contract and the seller having the 10 contract, okay, and both are the buying and selling or exchanging with each other. So it means not it is the 20 contract. It means the overall it is 10 contract. I hope you understand open interest. And one of the open interest means what? The opening position in the market. When this buyer and this seller to come to the agreement of the 10 contract, it means what? It is both side is 10 contract, not 10, 10, 20 contract. It's a overall 10 contract. Okay. If the new market, if the new buyer and seller enter in the contract, then it is the separately counted. But if the both buyer and seller are the agreement in the contract and they are agreement in the 10 contract, it means that it is not 10, it is not 10, it is overall 10 contract. The next future terminology is initial margin. Initial margin means the percentage of the purchase price that must be paid by the cash on the margin account. The next terminology is the maintenance margin. The every account holder have to be maintain the some margin in the margin account. Currently, it is set up of the 25% of the total securities. So the student, let's move on the next segment, that is the concept of the conversion. The conversion is the movement of the price of the future contract toward the spot or the cash price of the underlying commodity over the time. The price of the future contract and the spot price will be the equal to the delivery date. It simply means that the last date of the future contract can be the delivered to fulfill the terms of the contract of the price in the future, and the price of the underlying commodity will be the nearly equally. If the buyers predict that the price of the onion in the month of the September is 50 rupees, and at the time of the September, if it is actually the 50 rupees that it is the fully meet or fully expectations of the buyer. If it is the less than the 30 rupees, that it suffer the loss to the buyer. If it is the over the 60 and 70 rupees, so it means that the buyer gaining the profit in the month of the September. Now, in the concept of the conversion, the arbitrator play a very important role. We can say that the idea of the spot prices of the commodity should be equal to the future price of the delivery date is to be straightforward. And we can say the purchasing of the commodity outright to the day one, that is to be paying in the spot price, and the purchasing the contract that requires to be a deliver of the commodity to the day 30 means to be paying the future price. So are essential the same thing, and buying the future contract add to the extra step. For example, the step number 1, the future contract, and buy the future contract, and the step number 2, the take the delivery on the commodity. Still the future contract should be the trade at the near of the price of the actual commodity to the delivery date. So the forward contract have to be nearly the delivery date has to be pay or deliver. If the price are the change or diverse on the delivery date, there is the probability of the opportunity for the arbitrator. That is, there is the potential to gaining the profit or risk-free profit by the purchasing the lower price and to the selling in the higher prices futures contract. So here is the emerging of the arbitrator to take the advantages of the two commodities, that is to be buying from the lower commodities and the selling to the higher commodities. Now let's discuss the new terms that you hear the first time in the concept of the conversion, that is the contango. What is the contango? The contango described as a upward sloping curve where the price of the future delivery are higher than the spot price. That is the situation of the contango. For example, the price of the gold delivered in the 1 year is $1,400 and the spot price is the $1,200. It means that the spot price is less than the future price. So in this case, the upward curve of the future price, जैसे कि अभी upward हो रहा है gold price, then it is called the contango. The contango is common in the gold jewelry industry, and where the commodity is not perishable and there is the storage cost also. So it is called the contango. So contango is the describing is like upward situation. Now the student, next term is the backwardation. What is the backwardation? Backwardation describe the downward sloping because of the future price or future delivery is the less than the spot price. So this is the situation is called backwardation. For example, if the wheat price of spot is $10 and the future delivery price is it's $8. So the spot price is higher than the future price. Therefore, the backwardation curve is sloped downwards. And in the situation of the corona, where the stocks of the essential commodities are very less, the people are ready to be buy the higher price, means what the spot price is higher than the as a future price. So the drought or any natural disaster is the one of the good example of backwardation. Now the student, let's talk about the our next segment, that is the basis and the basis risk. In the future terminology, we already learned what is the basis. Basis is the differences in the cash price or spot price to future price. Now, what is the basis risk? The basis risk is the potential risk that is arises from the mismatch in the hedging position. Basic risk is occur when the hedge is the imperfect. If perfect hedging means the hedger gain and losses in the spot or the future market are not fully offset or balancing. Hence, it is end up the hedging position for the sum gain and the loss. It is called the imperfect hedging. It means, again I repeat, the imperfect hedging means what? When the hedger is not in the position to be a perfect balancing in the cash market or the future market, then he make the some gain or losses and back to the hedging position. It is called the imperfect hedge. So in the basic risk occur when the hedging in the imperfect, and so that the losses in the investment are not exactly the offset by the hedger. So the certain investment do not have the good hedging instrument. So making the basic risk is a more of the content with the other assets. So basic risk formula is the hedging spot position, hedging spot price minus the futures of the investment. Now quickly we discuss about the type of the basis risk. It is very important to the examination point of view. What is the basis risk? The first type of the basis risk is the price basis risk. The risk that is occur when the price of the assets and in the future contract do not move in the tandem with the each other. It means that the risk of the price of the asset and the future contract do not be move, and it is the static. So there is the always be a price basis risk. Now the second point is the location basis risk. What is the location? So as a name of the location, so the risk that is arises when the underlying assets in the different location from the where the future contract is traded. For example, let's see the example. For the example, the basis between the actual crude oil sold in the Mumbai and the crude oil future traded in the Dubai. So the future exchange may be the differ from the basis between the Mumbai crude oil and the Mumbai trade crude oil in the future. So location is matter for the in the basis risk. And the third type of the basis risk is the calendar basis risk. The selling date of the spot market position may be the different from the expiry date of the future market contract. Sorry, it's a future market contract. So the calendar base, the date of the expiry date and the date for the position, it's maybe changes due to the date of the different spot position and the future position. Now the fourth one is the product quality basic risk. Obviously, as the name, the quality of the product, where the properties of the qualities of the product is different from the asset as represented by the future contract. So it may be the risk when we sporadically we buy the some quality of product and the future delivery is something there is the some not be a good in the quality. So there is always be the product quality basic risk. Now the student, let's discuss with the next segment, that is the future pricing model. The first future pricing model including the cost of carry model. What is the cost of carry? The cost of carry it is to be cost associated with the carrying the value of the an investment. These costs can be including the financial cost such as the interest cost on bonds or interest expenses on the margin account, interest on the loan used to make the investment, and any storage cost involving in the holding the physical assets. So the cost of carry is the cost, the investment price plus carrying the all expenses. So the cost of the carry is also including the opportunity cost is associated with the taking one position over the another. In the derivative market, the cost of carry is an important factor for the consideration when the generating the value associated with the an asset of the future price. So the assets, if we calculating the future asset price, we including the cost of the carry. So the future price equal to the spot price plus cost of carry. Then we will get the price of the investment future price. Now, in the models of the future cost of the carry model in the derivative market for the future and the forward, the cost of the carry is the components of the calculations of the future price as which is mentioned in the next slide. It means that the future price, again I repeat, future price equal to the spot price plus the cost of carry. So the cost of the carry is associated with the physical commodity generally involved in the expenses tied to the all of the storage cost or investor for goes to be over the period of the time, and including the thing like the cost of the physical inventories, storage, insurance, and any other potential losses from the obsolescence. So it is the what the cost of the carry model. So future market price calculations also take into the considerations of the convenience yield, which is to be the value benefit of the actually the holding the commodity. So the formula of the find out the forward future pricing, that is SE in the bracket R plus S plus C into T, whereas to be F is the future price of the commodity and capital S is the spot price of the commodity, whereas to be R is the risk-free interest rate, and whereas to be E is the base of the natural logs approximately as the 2.718. Now small s is denoted the storage cost expressed as the percentage of the spot price. Now the small c, the convenience yield, and the t for the time for the delivery of the contract that expresses as the fractions of the 1 year. So this is the formula F equal to SE into in the bracket R plus S plus C into T. And any derivative pricing model involving the future price of underlying asset will be incorporated the sum the cost of the carry factor if they exceeded. For example, the cost of carry factor in the both direct investing and the derivative market, or investing in the direct or derivative market just like the stock, bonds and the currency. Carrying cost is detracted from the total return of the direct investment. In the derivative market, the carrying costs are the factor that influences the derivative contract pricing. Several costs of the carry factor that the investor should be account for: the margin, short selling, short, again I repeat, the short means what? Selling. The short selling and the other borrowing, the trading commission, storage, these are the cost of the carry. So again I repeat, the cost of carry means to be, if we have to determine the future price of the any commodity or the assets equal to the spot price plus cost of carry, it means all the insurance, all the storage and all the expenses incurred with that particular assets. Now the next future pricing model is the expectancy model. What is the expectancy model? It is also argued that the future price is the nothing but the expected cost of the future assets. According to this model, the future can be made at the premium or the discount. It means that the assets can be the increasing the price or the lower the price in the spot pricing of the underlying asset. The future price gives the market participation in an indication that the expected directions of the movement of the spot price in the future. For example, the gold price is nowadays is the decreasing, okay, as a comparisons for the previous year. So it gives the idea of the future gold that is the today's price. Now, if the future price is higher than the spot price of the an underlying asset, the market participation may expected that the spot price to be go up in the near future. So it is the Contango market where I'm discussed with you already. The Contango market means where the future market is the higher than the spot market. The curve is the upward sloping. Now, similarly, if the future price are the lower than the spot prices, or the asset will be the less in the the lower in the future market or future date, the mark at the participation may expected if the spot pricing is to be come down in the future. That is called the backwardation effect or backwardation market. So here is the detailed explanations of the future pricing model, that is the cost of the carry model and the expectancy model of the future pricing. Thank you so much for the watching me.